What I'm looking at is the price for TLT, which is the 20-year Treasury bond ETF from BlackRock. And I was wanting to evaluate selling cover calls against this position. Now, it's a little bit counterintuitive because usually I sell cover calls on leverage ETF or individual stocks that moves a lot with quite a bit of volatility. But I wanted to evaluate if I was to do the same thing on TLT. Now, this doesn't move a lot. In fact, over the past year, this thing is only down nearly 1.5%. And last Friday, it fell a half a point, just a little bit over a half a point. That tells me that it's pretty stable. It doesn't have a lot of volatility. Now, over the past 5 years, it's actually down quite a bit because in 2022 there was a huge bond crash. Okay, most of those bonds ETFs lost about 20-30% of their face value in 2022. But regardless, over the past 10 years, it's down a little bit over 30%. And from 2003, basically is flat. It's up just over 5.5% over the past 23 years. So I guess the point I'm trying to make is that this ETF doesn't really move a lot, and it might make a good candidate for selling cover calls against it, and having a pretty conservative strategy. In other words, if you sell cover calls against a high volatility stock, you might lose the shares, or you might experience the shares. You do keep the shares, but the stock price is plummeted. So now, yeah, you collected the premium, but you are way down on your principal. So I was trying to come up with an ETF that it doesn't move a lot, and you can rely that the principal stays the same, and in the meantime you can collect the premium, and on top of that you can collect the dividend, because dividends, let's see here, on the dividends side, this as of today, which is 1st of February, it pays a little shy of 4.5 dividend. And the good thing for you guys looking for income is that this pays monthly. Okay, it pays about 34 cents. Let me double check on that. The dividend history, it pays about 34 cents a share a month, and it appears that they pay twice in December, and then they do not pay in January, and start paying again the 1st of February. So basically, they pay first of the month. Okay. Looking back at the dividend history from 2025, ex-dividend, I believe it was February the 2nd, and then March the 2nd, March 31st. So if you wanna collect the dividend, you gotta own the stock right before the first of the month. Okay, of course you can check exactly what is the ex-dividend date. Regardless, I was wanting to see if it makes sense for me to write cover calls against it. Now, like you see here on the dividends, in 2025, they pay nearly $4 of annual dividend per share. Regardless, this translates in shy of 4.5 yield, annual yield average, which is pretty appealing if you think about it. A dividend ETF might pay you 2.5 to 3.5. If you want to venture yourself in a stock dividend paying an individual stock, you might collect the dividend, but you might lose on the principal, and then you always have people buying individual stocks right before the ex-dividend date, and then they sell it by the bulk the day after. So if you don't want to put up with all that volatility and a huge chance to lose your principal when you buy high dividend paying individual stocks, well, then a TLT can be a very good strategy. Now, if I go under the option chain, now notice something, okay? Today, 1st of February, now today the market is closed, it's on a Sunday, but I was gonna release this quick video. I was gonna get ready for the upcoming week. And what I noticed is that the expiration dates on TLT, February 2nd, which is tomorrow, Monday. Then there is another one, which is February 4th, of course, Wednesday, February 6th, which is Friday. And then again, February 9th, the 11th, the 13th of February. So basically you have 3 expiration dates weekly. So what does it translate into is that if you sell cover calls against TLT, you might profit. Every other day you might collect the premium, which is mind-blowing because at least based on my experience, a lot of those stocks and ETFs, they pay at the end of the month. So if the expiration date is like February 20th, the next one would be March 20th, next one April 17th, the next one May 15th. Now the good thing about this one is that you can set the cover calls, you can scatter them, and every Monday, every Wednesday, and every Friday you might collect the premium. Now I want to see how that translates into the weekly premium, because I can imagine that On TLT, the premium is not as juicy as you can make on very volatile stocks or leverage ETF. But regardless, that's why I want to find out more about the premium that this TLT would pay. But I think it's a plus because, again, I have never found something that pays 3 times weekly. I believe it's worth investigating. Now, because this is, of course, February 1st, I don't know, tomorrow the market opens and the premium and everything might change substantially, but TLT, let me double check, it closed on Friday at $87.13. Okay, now if I was to pick a strike price at 87.50, so it is slightly out of the money. Okay, now in that case I would profit. In that case I would profit 37 cents a share. If my shares are gonna be called away at 87.50, I'm gonna profit 37 cents a share on the appreciation, and let's call it 10 cents a share. So basically you are talking 37 cents a share plus 10 cents a share, stock price 87. Okay, so doing it 3 times because Monday, Friday, and Wednesday. Now this thing is going to yield over 1.5% a week. That if you can rinse and repeat this for 52 weeks of the year, this is gonna yield 84.3% on your money. 84.3%. And it is something that you can rely on because, like I was saying earlier, this thing does not move a lot. Now, there are, of course, a variety of reasons why this is a long-term treasury bill, ETF. It would be best to put your money into a short-term treasury bill, but I didn't find anything that would have a premium worthwhile to sell cover calls against it. So I think I'm gonna take another look at this TLT. Let me also ask AI and see what are your takes about investing long term into TLT?
Investing in TLT, iShares 20-plus year Treasury bond ETF, for the long term is essentially a high-stakes bet on the direction of interest rates and the health of the U.S. economy. As of early 2026, the sentiment around TLT is deeply divided between contrarian opportunity and inflationary risk. Here is a breakdown of the current takes on holding TLT long-term. 1. The bull case, the coiled spring theory. Many analysts view TLT as an undervalued asset that has suffered through one of the worst bond bear markets in history. Duration power. TLT has an effective duration of approximately 16 years. This means for every 1% drop in long-term interest rates, the fund's price could theoretically rise by 16%. Economic slowdown. If the U.S. enters a recession or even a growth scare in 2026, investors typically flee to the safety of treasuries, driving yields down and TLT prices up. Fed policy shift. With a new Fed chair expected by May 2026, there is speculation of a move toward more aggressive rate cuts, 75 to 150 basis points, if inflation stays near the 2% target. Yield carry. Currently, you are getting paid a decent yield, roughly 4.5% to 4.8% to wait. This provides a steady income stream that didn't exist during the zero rate era. 2. The bear case. Fiscal dominance and inflation. The primary fear is that long-term rates may stay higher for longer, regardless of what the Fed does with short-term rates. Debt and deficits. The U.S. government continues to issue massive amounts of debt to fund fiscal spending. This wall of supply can keep bond prices low and yields high because the market demands a premium to absorb all that debt. Structural inflation. If tariffs, geopolitical tensions, like recent rhetoric involving Iran or Venezuela, or a commodities bull market, keep inflation sticky, the Fed cannot easily lower rates without risking a price spiral. Yield curve steepening. We are seeing a bear steepener environment where the market expects growth/inflation to stay high, causing long-term yields to rise even if the Fed cuts short-term rates. 3. Strategic considerations. If you're looking at TLT for a long-term horizon, keep these factors in mind. Factor. Impact on TLT. Recession/deflation. Strong positive. Prices rise sharply as yields crash. High inflation/deficits. Strong negative. Prices fall as yields rise to compensate for risk. Volatility. High. Because of its long duration, TLT moves more like a tech stock than a stable bond fund. Correlation. Hedge. Historically, TLT moves opposite to the S&P 500 during risk-off events, making it a good diversifier. The verdict: investing in TLT right now is not a set-it-and-forget-it safe haven. It is a volatility play. If you believe the economy is cooling and inflation is dead, TLT offers asymmetric upside, potentially 15 to 30% gains if rates drop 1 to 2%. If you believe government spending and inflation are structural problems, you might prefer TIPS, Treasury inflation-protected securities, or shorter duration bonds to avoid the duration trap. Would you like me to compare TLT's performance against shorter-term Treasury ETFs or inflation-protected bonds, TIPS, for your portfolio?
Would you suggest to invest a lump sum into TLT or dollar cost averaging into it?
Choosing between a lump sum and dollar cost averaging DCA for TLT in 2026 depends heavily on your tolerance for duration risk and your outlook on the upcoming Federal Reserve leadership transition. Historically, lump sum investing outperforms DCA about 66% to 75% of the time because you get your capital working immediately. However, with TLT's current volatility and the 20-year yield hovering around 4.8%, the decision is more nuanced. The case for a lump sum: locking in yield. By investing now, you immediately capture the current 4.8% SEC yield. If you DCA over 6 to 12 months and rates drop during that time, you'll be buying the remaining shares at lower yields and higher prices. The safety flight hedge. If a sudden geopolitical event or economic data miss causes a market crash, TLT often gaps up, spikes in price overnight. A lump sum ensures you are fully positioned to catch that move. Technical support TLT is currently trading near the bottom of its 2-year range, around 84 minus 87. Many technical analysts view this as a buy the dip zone with a high margin of safety. The case for dollar cost averaging, DCA. Combating fiscal noise. The biggest risk to TLT is the massive supply of new U.S. debt. If the market gets spooked by the deficit in mid 2026, yields could spike to 5.2% or higher. DCA protects you from buying the top right before a yield surge. Fed uncertainty. We are approaching a Fed chair transition in May 2026. If the new appointee is perceived as inflation tolerant, long bonds could sell off sharply. Spreading your entry over 4 to 6 months buffers you against this political volatility. Emotional stability. TLT has a high standard deviation, approx 15%. It feels like a stock, but moves like a bond. If a 5% drop in price would make you panic sell, DCA is the better psychological path. Comparison at a glance. Strategy. Best if. Major risk. Lump sum. You believe the 4.8% yield is the top, and a recession is coming soon. A surprise inflation spike or debt crisis pushes yields to 5% plus. DCA. You are worried about fiscal deficits or higher for longer inflation. You miss out on a massive price rally if the Fed cuts rates aggressively. A hybrid suggestion. If you are torn, a common institutional approach is the 10th of October 50 rule. 1. Invest 50% as a lump sum now to secure the current high yield and establish a base position. 2. DCA the remaining 50% in monthly installments over the next 5 months. 3. Accelerate. If TLT drops another 3 to 5%, yields hit 5%, use your remaining dry powder to finish the investment early. Would you like me to look at the specific historical drawdowns of TLT to help you set a limit order price for your entry?
What do you think about selling cover calls against TLT on a weekly basis starting today?
Selling weekly covered calls on TLT is a popular income strategy, but in the current 2026 market environment, it shifts your investment from a long-term bond bet to an income generation business. Here is the breakdown of the risks and rewards for starting this today. 1. The potential return profile. Currently, TLT is yielding roughly 4.8% in dividends alone. By selling weekly covered calls, traders are often targeting an additional 8% to 12% in annualized option premiums. Total target yield, approximately 13% to 17%, dividends plus premiums. The income shield. If TLT stays flat or drops slightly, the weekly premiums act as a cushion, lowering your effective cost basis every Friday. 2. The current 2026 environment, the volatility trap. The primary risk today isn't that TLT will go to zero, it's that it might spike without you. Fed leadership transition. With the new Fed chair taking over in May 2026, the bond market is jittery. If the Fed suddenly pivots to aggressive cuts, TLT could jump 5% in a week, capping your upside. If you sell a call with a strike price of $88 and TLT rockets to $92 on a flight to safety, e.g., geopolitical tension, your shares will be called away at $88. You keep the premium, but you miss out on the $4 per share capital gain, which is the main reason most people buy TLT in the first place. 3. Weekly versus monthly calls. Feature. Weekly calls. Monthly calls. Premium income. Higher, due to frequent theta decay. Lower per week. Management. High stress. Requires adjustment every few days. Set and forget. Gamma risk. High. A small move on Thursday can flip your position. Lower. You have more time for the price to revert. Flexibility. Best. You can skip a week if a major CPI report is due. Locked in. Harder to dodge news events. Strategy recommendation. The defensive income approach. If you start today, consider these pro guardrails to avoid getting steamrolled. 1. Sell out of the money, OTM. Don't be greedy. Look for strikes with a 0.20 delta or lower. This gives TLT room to breathe and grow while you still collect a smaller check. 2. Avoid event weeks. If there is a CPI data release or a Fed meeting that week, do not sell a call. The volatility usually spikes, and the risk of a massive move against you is at its highest. 3. The income ETF alternative. If managing this weekly sounds exhausting, look at TLTP, Amplified TLT 12% Income ETF, or TLTW. These funds do exactly what you're proposing, selling weekly/monthly calls on TLT and pay it out as a high monthly distribution. The verdict: selling weekly calls is great if you think interest rates will stay sideways for the next 6 months. It is a disaster if you are bullish on bonds and expect a massive rally. Would you like me to pull the current option chain for this Friday so we can see exactly how much premium you'd collect for a specific strike price?
Regardless, I think it provides a good edge against my other positions that I have in my portfolio, because I do have a lot of triple X QQQ, ticker TQQQ. I do own quite a bit of SOXL, which is the triple leverage semiconductor ETF, and because this moves on the opposite side of the S&P 500, and I do think that the stock market is ahead of itself. Also, being 2026 a midterm election year, where always we experience in election year a drop on the S&P 500, usually from March to August. I believe that this can be a good diversify, and I might pull the trigger on selling cover calls against it. So again, if I was to do it 1 week out, February 6th, this is gonna put 32, 33 cents a share deposit in my account, plus 37 cents a share of stock appreciation, and that's every week. Okay, now of course you're not gonna hit the appreciation every week, but you do collect the premium. So in the worst case scenario, if you are making 33 cents a share on a 87 stock price, and you do it every week, that's about 20% return on your money, and that's pretty much a guarantee. Now of course if you sell it, you get lucky, and you get the premium, and you get the appreciation, and you're gonna keep the shares for the 4.5 dividend. Well, in that case you're gonna make twice that. So I believe it's worthwhile to give it a chance and see how everything goes. Nonetheless, like a diversifier on my portfolio, I do buy bonds. I do have bonds ETFs. Regardless, they pays anything between 3, 4, 5. Then I do have some of the junk bonds ETFs paying all the way up to 11, 12, 13. And I think this is going to be a good option to have, especially if you're looking to optimize your income. Other than that, you're probably better off just selling cover calls against a stock or a leverage ETF. Well, then tomorrow that's what I'm gonna do. Happy trading.